Hello, and welcome to Accolade's market update for credit unions. My name is Phil Lucas, and I'm the Senior Balance Sheet Advisor at Accolade. I'm also joined by our VP of Advisory Services, JD Pizzula. This update is part of our ongoing efforts to support credit unions as we work together to navigate these uncertain times. This presentation will serve to summarize and condense the most important developments over the last few weeks, as well as highlight a few areas of focus for credit union strategy. This recording was made on Thursday, December 17th, 2020.
Okay, let's start with a quick review of U.S. gross domestic product and expectations heading into 2021. So after many years of stable GDP growth coming out of the financial crisis, we entered a technical recession earlier this year after experiencing back-to-back quarters of negative growth in Q1 and Q2. In the second quarter, GDP declined at an annualized pace of greater than 30% as lockdown measures eased. We saw a Q3 GDP reading come in at over 33%, which made up for much of the lost GDP from earlier in the year. However, the total GDP remains almost 5% below where we started 2020. When considering Q4 GDP, we typically look at Atlanta Fed's GDP Now model. Now, while the street consensus estimates for Q4 GDP come in around 4%, the Atlanta Fed model currently estimates Q4 GDP to come in around 11%. However, as many states and cities re-enter lockdown protocol due to virus spread, it is likely we will start to see some deterioration in the data inputs to this model, which would likely bring the GDP Now model estimates closer in line with street estimates. Now let's look at potential GDP versus actual GDP since 2005. The blue line here represents potential GDP and the gray line represents actual GDP. Potential GDP is more of a theoretical concept of what a nation's gross domestic product would be in a stable inflation and maximum employment environment. Now, as you can see, prior to the financial crisis, the U.S. economy was operating right at potential GDP. However, coming out of the financial crisis, actual GDP remained below potential GDP for about 10 years until the jobs market pushed through what had been considered maximum employment in the textbooks. We remained there until the onset of the pandemic and now find ourselves about 5% below potential GDP. While this pandemic-induced recession is quite different than the asset bubble-induced recession we saw last time, it is important to consider that it may take many years for the U.S. economy to return to maximum gross domestic product generation. As fixed income investors, our investment yields and returns are largely dependent on Fed policy. Traditionally, the Fed has operated with a dual mandate of maintaining a reasonable level of inflation while maximizing employment across the economy. So let's first review the outlook for inflation in the United States. For many years now, the Fed has targeted 2% inflation, and their preferred metric is personal consumption expenditures, or PCE. On this chart, you'll see a green line plotted right at 2%, which is their target, and you'll see that outside of a few months in 2018 when the Trump tax cuts helped spur some inflation, this metric has consistently registered below the 2% target. And as a result, the Fed in September adopted an asymmetric inflation targeting policy where they will no longer preempt inflation like they had typically done over the last 40 years. And instead, the Fed has indicated that they will temporarily allow inflation to run in excess of their 2% target in order to bring the longer-term moving average of inflation back in line with their 2% target. So as a result, it is the opinion of both Accolade and the market at large that the Fed will be less proactive when it comes to making future rate hike decisions. Now let's look at a market indicated expectation of future inflation. So this chart illustrates the 5-year forward break-even inflation rate, which captures the spread between the yield on Treasury inflation protected securities, known as TIPS, and Treasury coupon bonds at the 5-year tenor. The spread between the two is currently around 1.9% for the next 5-year period, which also comes in below the Fed's target of 2%. Given the current inflation readings and the expectation for inflation over the medium term, as well as the Fed's pivot in inflation targeting, it is easy to see why most economists and market participants are planning for a lower for longer strategy around fixed income, where the Fed funds rate could be stuck at zero for the next 5 years and potentially longer than that.
Recovery in the employment market continues to slow to a troubling pace. Early December readings for non-farm payrolls increased by only 245,000, far short of the Wall Street estimate of 440,000 and even further behind the 610,000 increase in October. Of the 22 million jobs lost this year, we've recovered a bit more than half so far. Weekly initial jobless claims continue to come in each week at around 7 to 800,000. It's estimated that just under 19 million Americans are currently receiving unemployment benefits. As we often mention, the U.S. economic performance is driven by a little over 2/3 based on consumer spending, and so elevated unemployment is expected to continue to drag on the recovery. One of the more troubling aspects of the unemployment situation is that the expanded UI benefits that impact approximately 12 million recipients are set to expire at the end of the year, adding more pressure for Congress to pass another round of stimulus. Another trend that we're seeing is a shrinking labor force participation rate. For several years prior to 2020, the labor force participation rate was stable near 63%. It troughed at just over 60% earlier this year, but is currently trending around 61.5%. If that trend holds, it would signal a real challenge for continuing GDP growth in the future, as it becomes increasingly difficult to replace the economic output power of those workers. By the way, this trend is also helping to bring down the official unemployment rates, while the actual jobs recovery pace slows, as a lower participation rates shrinks the denominator of that equation. I think it's very important to think about these trends in the context of the areas or sectors of the economy that are the most impacted. Fed Chair Jay Powell has mentioned several times that the impacts of the virus will accelerate some longer-term trends, and that there's no going back to the economy as it was before. The chart here on the slide shows a real-time example of just that in the retail sector, as we chart retail sales in blue versus number of retail jobs in orange. For several years, retail has been going through the process of moving away from brick-and-mortar stores and onto digital sales avenues. From 2016 to 2019, the pace of retail sales significantly outpaced the growth in retail jobs, leading to higher revenue with fewer workers. While the shutdowns earlier this year shocked both sales and jobs, retail sales have actually recovered to higher levels than before the pandemic. However, a significant number of retail jobs have still not come back and probably never will. The elevated levels of unemployment in the labor market and the larger macro trends of less lower-skilled jobs being available will likely continue to shape policy and stimulus efforts in the future.
Now let's take a look at how interest rates have changed over the second half of 2020. Back in March, we realized an interest rate shock down to zero, and short-term rates have remained stuck there within the Fed funds range ever since, going out to 3-year tenors. This has left short-term investors, especially CD investors, exposed to significant reinvestment risk as higher yielding investments have rolled out of the portfolio and have been replaced with ultra-low rate investments. Of course, this has always been a risk with short-term CD-only strategies. These types of investors were able to capture higher rates back in 2018 and much of 2019, but we're also incurring huge amounts of reinvestment risk, which hit home earlier this year. We often talk about this when reviewing ALM reports with our clients in the discussion of interest rate risk sensitivity. By maintaining a low level of interest rate risk in those up 300 basis point regulatory shocks, the trade-off is that a credit union is overly exposed to downward rate shocks like we realized earlier this year. Further out the curve, we have seen some steepening, and interest rates have slowly but steadily climbed at tenors 5 years and out, as illustrated by the green line on the chart. The 5-year Treasury continues to trade toward the upper end of its range and is around 37 basis points this week. The 10-year Treasury continues to inch back towards 1% and is just over 90 basis points this week. So looking into 2021, most fixed income research desks expect interest rates to remain in a range similar to what we're seeing today, with most target yields on the 5-year Treasury by 2021 year end coming in around 50 basis points, and target yields on the 10-year coming in between 1 to 1.25%. All right, now that we've got the data and interest rate stuff out of the way, let's take a quick look at investment opportunities as of this week. So we'll start with the ugly stuff, CDs. We put out a brief research piece about why we consider CDs to be largely uninvestable, and be sure to give it a look if you haven't already. But we are seeing most offerings in this space at or below the current Fed funds range. CDs still make some sense if you can invest opportunistically, which means picking out yields that are better than 25 basis points out to 3 years and at or better than 50 basis points at the 5-year tenor, assuming that maybe we'll get one rate hike between now and 2025, 2026. Although callable spreads remain tight, we continue to like agency bonds as an alternative to CD buying because the yields are comparable and somewhat better. Plus, these investments offer increased liquidity to investors. Floating rate investments haven't changed much over the second half of this year, but offer a good cash proxy from an IRR perspective, and they offer yields that are about 2 times better than Fed funds, so that's great too. Lastly, for credit union investors who are looking for yield in the credit risk-free space, fixed rate CMOs remain your best bet, where we are seeing 3-year average life investments around 75 basis points and 5-year average life investments around 1%. Now, I've said it before, but let me say it again, folks. 1% is as good as it gets for credit risk-free permissible investments, and this is not likely to change anytime soon unless we see some sort of inflation surprise dramatically to the upside, or unless we see some sort of drastic shift in the Fed's quantitative easing policies.
While there have been very few feel-good news stories to report in recent months, the pace at which vaccines have been developed for COVID-19 is truly a cause for both hope and celebration. Widespread vaccination could bring daily life back to some sense of normalcy in the latter half of 2021. However, as I'm sure many of you already expect, the increasing case counts and upcoming holidays are likely to lead to some of the most brutal months in early 2021. When widespread immunity is established, economists are expecting that it will be a long road to economic performance at pre-virus levels. If that fully reopened economy occurs in 2021, it's possible that we'll see a demand glut for goods and services that were limited through the pandemic, such as vacations, travel, restaurants, and the like. For higher quartile income earners, savings rates have been elevated at a significant level for quite some time. At the same time, supply of these types of services is likely to remain depressed for a time, as these industries have been particularly hard. This could lead to a significant increase in prices. However, there are other sectors of the economy that we do not anticipate a short-term recovery for, as some of the new behaviors learned during the pandemic are likely to persist. For example, demand for commercial real estate is likely to be at a lower level as work-from-home arrangements in some companies may become permanent. It will be critical in 2021 for credit unions to assess: 1. What are the savings behaviors and potential spending behaviors of our members? And 2. Are the businesses that the CU works with poised to benefit from a post-virus world? As JD discussed earlier, interest rates are likely to remain at the zero bound for the next few years, which will likely continue to put pressure on interest margin for credit unions. When there's pressure on interest margin, it's important to strategically think about what types of non-interest income are available. In addition, subsequent rounds of stimulus could put more pressure on credit union capital ratios. Because of the rapid changes to credit union balance sheets in 2020 and the overall uncertainty created by the pandemic and subsequent economic trouble, we can fully anticipate that regulatory groups will be conducting exams with increased scrutiny. The NCUA released a report recently that showed across the industry outstanding loans declined, loan to share declined, median ROA declined, and the percentage of federally insured credit unions with positive net income declined as well. As always, we recommend regular documentation of both your strategy as well as discussion around what areas of risk is the credit union exposed to. Now's the time for open and candid conversations. Create a plan, execute on it, and analyze the results. 2020 has been a hell of a year. We at Accolade consider it both an honor and a privilege to work with you and your management teams to support your efforts to serve your members. This will be our last update for the year. We'll resume our normal bi-monthly video schedule on Thursday, January 7th. Thanks for tuning in, and a very Merry Christmas and a Happy Holidays to you and your families. Accolade is a registered investment advisor, and I'm required to ask you to review the disclosures on the last slide here. While the future is uncertain, it's important to remember that with every challenge comes opportunities. The coming weeks and months are likely to be a time in which your members need you the most, and doing good work for them through these times may be a way to forge relationships that last a lifetime. Wishing you all peace and health, and talk to you soon.